Today, we will talk about house maintenance requirements, what it is, how it works. A house maintenance requirement is the level of minimum margin account equity that is required by a brokerage firm. House maintenance requirement levels are based on the standards set out in Regulation T of the Federal Reserve. Although Regulation T specifies the minimum maintenance requirements permitted by law, brokerage firms are free to adjust their own house maintenance requirements, provided that their standards are more rigorous than the minimum requirements set out in Regulation T. The purpose of maintenance requirements is to ensure that investors using margin accounts to make leveraged investments do not find themselves unable to repay their margin loans. In this manner, maintenance requirements are intended to reduce credit risk for the brokerage firms. By extension, they aim to reduce the systemic risk that might otherwise arise from widespread defaults by margin traders. According to Regulation T, margin traders must maintain equity levels of at least 25% of the value of their investments. If they fail to maintain this level, they may find themselves subject to a margin call by their broker. In this situation, the trader would be required to promptly deposit additional collateral into their account. If they fail to do so, their broker can liquidate their investment positions in order to pay back their margin. Any outstanding balance of the loan would then need to be repaid separately by the margin trader. During bull markets, margin traders may find their maintenance requirements to be unduly restrictive. When asset prices are generally rising, it can be tempting to leverage as much as possible in order to maximize return on equity. However, the danger of this quickly reveals itself once the market begins to turn. During bear markets or periods of sudden financial shock such as occurred in the 2007 to 2008 financial crisis, margin traders are often faced with significant risk. The decline in portfolio values, combined with the need to repay large margin loans on short notice due to margin calls, can sometimes force margin traders into significant financial duress. Often, these traders will forfeit all of the gains made in previous years, and may even be forced to liquidate other personal assets in order to repay their margin loans. Therefore, from this perspective, the need for maintenance requirements becomes much more clear. The house maintenance requirement will often be higher than the maintenance margin set out by the Federal Reserve's Regulation T, which stipulates that an equity level of at least 25% must be maintained. In addition to maintaining higher, more stringent house maintenance requirements than the 25% mandated by Regulation T, brokerage firms often also have different house maintenance requirements for different account holders. Typically, this stratification is based on the size, creditworthiness, or perceived sophistication of the client. The type of investment can also have an impact. For example, small, more volatile stocks may carry higher margin requirements than an investment in a big, well-established S&P 500 company. A house maintenance requirement is the minimum equity an investor must hold in their margin account after making a purchase. Once a security is bought on margin, the requirement kicks in. FINRA demands that at least 25% of the total market value of the securities be in the account at all times. However, brokers tend to demand even more than that. It's very important to pay attention to these requirements. If you fall below them and don't act fast when prompted, your broker could liquidate your investment positions to claw the money back. Here are 4 key takeaways. 1. House maintenance requirements are the standards for minimum margin account equity levels chosen by brokerage firms. 2. They must be greater or equal than the 25% level stipulated in Regulation T. Often, they are in the 30% to 50% range. 3. Brokerage firms will sometimes grant lower house maintenance requirements for their larger or more sophisticated clients, although these figures will always be at or above the 25% minimum. 4. House maintenance requirements can also vary depending on the type of investment, with volatile, less liquid ones likely to require more equity for protection. Hope this would help. Thanks for watching.